Hello everyone and welcome to the December edition of our monthly fixed income update. Let's dive straight into what shaped the markets in this period. At start of the last year, the narrative was simple. Rate cuts would tame the yields. However, reality proved more complex. Across G10 economies, central banks eased aggressively, yet long-term rates barely flinched. In fact, in the US, 10-year yields climbed even higher as the Fed slashed rates. This is because fundamentals like growth expectations, inflation expectations, and bond demand and supply don't vanish with policy tweak. Similarly, India is no exception. Despite RBI's liquidity injections through continued OMOs, even as recently as December 2025, long-end yields have moved higher. Higher bond supply and global spillovers continue to dominate the narrative. Liquidity infusions helps, but only at the margins. And then came the sharp INR depreciation, breaching 91 levels before clawing back. That move rattled the market, even though the domestic backdrop looked like textbook Goldilocks: strong growth, soft inflation. External shocks in the form of steep US tariffs, geopolitical jitters, and persistent FPI outflows remain the reasons for the move. The current account deficit looks benign as a percentage of GDP only, but in absolute terms, it was a hefty number. RBI had to step in, but had limited flexibility and intent with significant forward liabilities. Going ahead, the INR's outlook is constructive, but we can't expect any fireworks. It can end stronger for the year if US tariffs are eased and debt inflows materialize. Supporting factors like resilient services exports, moderating gold imports, and possible index-linked debt flows, if index inclusion is announced, are going to determine the rates. But the key risk still remains. A hawkish Fed could revive the dollar, and FPI flows may remain fickle. We expect central bank to stay tactical, smooth volatility, rather than defend any particular levels on INR front. For investors, this can mean a comparatively stable currency backdrop. RBI has not shut the doors on rate cuts, but the CPI projection for first half of FY27 is 4%. The bar for further rate cut is higher. Big duration trades are behind us. Carry and roll down will matter more. Liquidity support will remain critical in busy credit season in this quarter. And OMOs are the preferred tool as they create space for banks to lend and absorb government bond issuances. On bond supply side, because of high SDL issuances in Q4, spreads may stay wide, but it can provide a good entry point as we move to FY27 and the budget narrative becomes a focus. That's it for now. Thank you.
Mutual fund investments are subject to market risk. Read all scheme-related documents carefully.